You think you're trading against other people. You're not. You think price is set solely by supply and demand. It isn't. The price of Bitcoin isn't determined by me or you. It's decided over here. Dark pools. These are private crypto markets where the real money moves before the rest of us even see a ripple. In traditional finance, dark pools allowed institutions to trade large volumes without moving markets. In crypto, an unregulated, decentralized playground, they've become even more powerful, hidden, and consequential. Most traders assume the market works like this. Log onto an exchange, place an order, and if there's a match, the trade goes through. It seems on the outside fair and transparent. Wrong. Here's the truth. The big players aren't buying or selling on Binance or Coinbase. They execute their trades off books in private dark pools. Here's how a dark pool trade happens. Step 1. Private connection. The buyer and seller connect privately. This connection might be through an over-the-counter desk, secure Telegram channels, or even through automated smart contracts on private DeFi protocols. Step 2. Price negotiation. They negotiate a price based on recent public data, often an average price, to avoid slippage and public exposure. The agreed upon rate remains confidential. Step 3. Silent execution. The trade is executed within the dark pool. No order appears on any public exchange. No sudden price spikes or alerts, just silent, massive transactions. Step 4. Delayed reveal. Later, when assets are moved onto public exchanges, the market is already aware of the normal price, but by then, the heavy hitters have set their positions. By the time you see a price move on your chart, the real action has happened hours, even days before. In theory, when you see a large whale wallet tracker send a red alert that a huge amount of crypto has moved between wallets, this is likely the explanation. Think Michael Saylor. Consider the 2021 Bitcoin rally. Everyone assumed retail FOMO was driving prices sky high, but the story was far more sinister. In February 2021, Tesla disclosed in SEC filings that it had purchased approximately $1.5 billion in Bitcoin. On-chain analysis from firms like Glassnode and CryptoQuant shows that institutional wallets began accumulating Bitcoin in private channels weeks before the public announcement. By the time retail investors noticed the rally, these institutions had already positioned themselves using dark pools to minimize market impact. Retail traders were left buying into an already overheated market, eventually becoming exit liquidity. FTX's implosion wasn't a sudden event either. Warning signs emerged in the dark pools long before the collapse. Weeks before FTX collapsed in late 2022, on-chain data from CryptoQuant and Messari indicated that Alameda Research was moving over $4 billion in assets via dark pool trades, well before FTX's financial issues became public. While public exchanges displayed little to no massive sell-offs, dark pool transactions were offloading FTT tokens and other assets in secret, destabilizing the ecosystem from within. FTX wasn't brought down by a single public trade. It was a controlled demolition executed in the shadows, a classic case of hidden liquidity working against unsuspecting retail traders. Why does this hidden market matter? Because if you're unaware of where the real trades occur, you're always reacting too late. There's 3 ways dark pools control the market. 1. Front-running retail. Institutions quietly accumulate assets in dark pools. Once their positions are secured, they allow the price to move, trapping retail traders who only ever see the after effects. 2 is false liquidity. Large sell walls may appear on public exchanges, but they're often decoys. The true liquidity, controlled and manipulated, remains hidden. 3 is stop loss hunting. By triggering stop losses through strategic off-market selling, big players force retail traders into liquidation, then swoop in to buy at a lower price. Those who seem to know the market aren't psychic, They're simply playing the game on a different, hidden level. Dark pools aren't exclusive to crypto, they exist in traditional finance too. But in crypto, the playing field is far less regulated. Firms like Jump Trading, Cumberland, DRW, and Alameda Research once upon a time dominate this space. They avoid public exchanges entirely, trading in hidden venues where they control the flow and set the rules. In the crypto world, there's no oversight, no regulators ensuring transparency. This isn't illegal. It's simply the current state of an emerging market where regulation is lagging behind the innovation. They see the real flow, they move first, and by the time retail notices, it's already too late. Now let's make this super simple. Imagine you're at an auction for a very rare toy or item. Everyone shouts out their bids, but before the auction even starts, a secret deal happens behind the scenes in a back room. The real buyer gets the toy without ever joining in on the shouting. That's a dark pool, the biggest trades happening in secret, long before you see them on an auction block. By the time you notice, it's far too late to join the winning side. This is why most traders lose. The markets you see, the public price, is just the surface level. The real action takes place behind the scenes, in the dark pool market where institutions set the pace. Before you see the first candle move, the game has already been played. To learn more about the inner workings of the financial markets, especially crypto, and learn how to navigate through this better and use this information to your advantage, I would highly recommend becoming an Innovation Markets member today. There's a lot to learn inside our app.